First up, the Berkshire Hathaway annual general meeting is widely hailed as the Woodstock for capitalists and investors around the world. They make an annual pilgrimage to hear Warren Buffett and his alter ego Charlie Munger speak. During the course of the 5.5-hour question and answer session, investors get many insights into the principles of successful investing. One of the people attending this year was Sim's very own Corky Koyman, and he joins us from Cape Town to discuss what he learned. Well, Corky, we are looking forward to these insights. Can we start with what you deem was the overriding mood in the current investment climate?
Yeah, well, I wasn't expecting that one.
A mood question.
The overriding mood, especially in the States, and after Berkshire Hathaway, I spent another 2.5 weeks there just visiting a lot of the banks. But the overriding mood, and you can see it in the markets in the US, is actually very good, very positive, in that house prices are going up and your new housing starts have started to rise. As your new housing starts pick up, it means there's more construction, and so the unemployment is coming down. So generally people are actually quite positive, and a lot of the banks and other interviews we had felt that along with the shale gas developments that are taking place, and it will transform the US in the next 10 years, the US might have the best 10 years ever. So, but the mood in the US was actually, I was surprised how positive it was.
Corky, obviously we wanted to just we've got an audience that might be uninitiated to this concept of the Berkshire Hathaway annual general meeting. Just to get this right, as I understand it, we have thousands of people around the world fly to Omaha, Nebraska to listen to two octogenarians answer questions for, I think, 5 hours in the first session, and then I think there's other activities going on there. What in your right mind would people want to do that for? Just explain that to us.
Yeah. It's interesting that it started, I think the first meeting must be 40 years ago, almost 50 years ago, started with 9 people, and the people who do come are investors, or people who invested in his shares, and so really get a feedback from him in terms of how he's done over the year and what his outlook is going forward. And sort of as that grew, a lot of people have started buying the shares just to be able to go and listen to what they have to say, because as you say, they are octogenarians and they've got a lot of experience. So I think this year there were about 33,000 people, and increasingly is a very large international component. I would say almost, as it must be more than 15-20% of that is international, from as far as Australia, India, China. People stand up from everywhere asking questions. And the questions really range, whereas they should be about Berkshire Hathaway, but they actually range from, what do you think is going to happen to the gold price? What do you think will happen to the dollar? What do you think of the US government? And, so it's actually, you get a bit of a global economic view, or their view, and you get a bit of an MBA and investment at the same time. So it's just an awesome learning experience of two of the best investment minds in the world. You sit and listen to them for 5.5 hours.
You obviously deem it to be worthwhile. Did you come away with groundbreaking investment advice, Corky?
There was one fascinating answer that Charlie Munger gave. Now he's straight down the middle. He doesn't take prisoners, as they say. Someone asked him, what does he expect, the Berkshire Hathaway share price to do in the next 6 months, and markets. And Charlie Munger just said, look, anybody who asks that question shouldn't be in the room with us. So especially where markets, as we speak, are very volatile, their perspective is always, you've got to look at the quality of the business and the longer term, and don't try and forecast the short term. You can't. So you've got to have a very good handle on what the intrinsic value of a business is, and all the answers that they come out with, just focus on that. Get to know the business, and get to understand. So they will, for instance, never invest in a gold mine, no matter how cheap, because in their minds they can't forecast what the gold price will do and how profitable a gold mine will be. They will far rather buy a good retailer like ShopRite, which might be too expensive now, but then they'll sit and wait until ShopRite gets to the right valuation and then invest. So I think the advice now, where markets are volatile and you're getting some severe price movements down, especially in emerging markets, it's becoming time where you're getting great value again, and this is time where you should be investing.
Koki, obviously it's been fascinating to see how Warren Buffett's interpretation of value investing has changed over the years. I think he started off talking about the cigar butt approach to investing, where he'd literally pick a company that he could buy at less than working capital and invest in it almost for a short period, because the value would then rise and then he'd get out because he would never want to hold it long term. Perhaps just give us your take on how you've seen him change his style, and why has he continued to be so successful across his investing career, which now spans 60 years?
Yeah. Interesting, we did that with our team once, where we took the first Monday of every month and we took all his 50 letters that he wrote to shareholders over the 50 years, each annual report and letter to partners, and we analysed them 8 per month. And Mondays everybody took off and read 8 letters, and the Tuesday morning we'd get together and discuss them. And it was ideal to see how his investment style had changed. And exactly as you say, that his early years, he was influenced by Benjamin Graham, who very much was a very strong value investor. So he just looked at balance sheets, assets that were mispriced. As Charlie Munger came into the picture and started influencing Warren, and Warren realized that sure, you can make money that way. You can buy mispriced assets, and sometimes things like Lonman or whatever, gold shares do become mispriced. But in the end, it's gambling. And if you can find good businesses, as I said earlier, and invest in those and stay with them, you do much better. And so you can see over the years where he started finding good businesses and just held on to them. So look, there is a factor that you mustn't forget, in that they've become such a size now that he tends to hold forever, as he says. But he's admitted in question and answer time that were his fund to be smaller again, he most probably would trade more, because you do get a time where shares do become too expensive, and you do have to sell them, or you at least have to reduce your holding. But he's done exceptionally well just by finding good shares and holding on to them. So I suppose in that regard, if you do that, you can't go too far wrong.
Koki, just looking at the momentum investors or the growth investors that have managed to outperform, relatively broadly speaking, given the quantitative easing phenomenon that has really changed the game, so to speak. You've got all this money looking for a home, excess liquidity. It may have changed the rules of the game. Did they allude to their thoughts on quantitative easing? Because it's not just a short-term phenomenon. This looks as though it's going to be with us for a long term. For a long time, rather.
Yep. Yeah. In fact, the quote was that I wrote down is that they said that the Fed is busy with an experiment that has never been done before, and so we don't know the outcome, which is a bit scary. And a lot of the stuff that they said was revolving around that in 2007, 2006, 2005. The U.S. government should have taken the punch bowl away when the party got on too late and the participants were getting drunk, and they didn't. So now we're sitting with a hangover period, and you're trying to feed medicine, but you literally don't know what the outcome is. Having said that, now he's quite nationalistic and patriotic in that regard, but he was actually complimentary about the Fed and the U.S. government as to how they handled the situation, and they think, at this stage, up to now, quantitative easing in what they've done was the right thing. And you can see that in how the US economy is recovering. But in terms of the future, they said, if you look at the odds, the probabilities are that over the next 5-10 years, and that's the time span they think in, that interest rates will have to go up. And so you've got to think different, and now a lot of the money you were alluding to, a lot of the short-term theme money is chasing, the short-term gains, but forgetting that interest rates will go up at some stage. And I think almost that's what's happening now, while the rand is weakening, while emerging markets are falling, because there was a lot of money that chased into emerging markets, growth in emerging markets, Suddenly, with interest rates in the US looking as if the Fed might end quantitative easing, and with interest rates they're possibly going up, money is fleeing out of emerging markets again to sort of the potential higher interest rates in the US. So they alluded to that as well. They said these are amongst the most difficult investment conditions they've seen. And certainly, I can attest to that as well. It's you've got to be very strong on what you believe. And in fact, it was interesting what you said. The rules of the game don't change, but they seem to change for periods. And they sort of almost as a fund manager, you just think, I don't understand the rules anymore. And just when you're about to give up on the rules, they revert back to normality. And so you've just got to have your philosophy and stick to it. And at this stage, a lot of fund managers and investors are being buffeted around by no pun there on the buffeting, but they in terms of what's happening.
Corky, it's always I always find it fascinating how clear his thinking and Charlie Munger's thinking is, and especially with regards to Charlie Munger, how candid they are talking about things, and not being too complimentary of certain management teams, certainly in the finance sector over the last 5 years. But what was interesting is we've seen with tracking Berkshire's investments, they've converted their stake in the Goldman Sachs preference shares into equity, and also Warren Buffett's been a big buyer of Bank of America and Wells Fargo. So I know you're a banks expert. I wanted to just get your take and see what you thought of those moves, and whether likewise you held those in your portfolios as well.
Let's start with two of them that we do agree with what Buffett is doing. One is his two biggest bank stakes beside American Express is not really a bank, but in the financial services industry, but the two biggest stakes on Wells Fargo and US Bancorp, which has been one of the best run banks in the US. It's a bank with an amazing track record, and during 2008 came through unscathed with no bad debts, not really picking up dramatically compared to the others. So he's two picks there, and we've held US Bancorp and Wells, and we still hold US Bancorp. We think it's actually still mispriced. Wells is actually relatively expensive and getting foolish, with the double O, foolish. Bank of America was a very clever move of him in that when he invested, it was almost down and out. And there was a huge confidence crisis, but he knew management, and he could see the value, and he did a calculation on the potential legal costs from the mis-selling. And he said, even if I account for those legal costs, Bank of America is still cheap. And when he got the offer to buy, remember what people tend to forget, when he buys into Bank of America and the same transaction with Goldman Sachs, he actually gets preferred debentures or preferreds on a 9% yield, 10% yield, which he can then convert at a later stage. He gets warrants as well, and he gets, so he actually takes no downside risk. When he bought Bank of America, he took no downside risk. He gets a 9% yield, well, no downside risk. If Bank of America does go bank, then he does stand, but he gets a 9% yield, and he gets to convert into the shares. So it was a brilliant deal for him, and once he invested, it turned investor confidence towards Bank of America, and the same with Goldman Sachs. Bank of America, we think, is still good value. Katerina has done a lot of work for us there, and it's good value. We just didn't want to take the risk there, and we'd rather stuck to JP Morgan and Wells and US Bancorp. Goldman Sachs, I disagree with Warren there. It's interesting. He knows them very well. He's got a soft spot for them. We just don't like investment banking as a model. But then we play globally, so we'll rather buy good US Bancorps in other countries than an investment bank in America.